It's another great time. The advanced financial reporting and analysis students, we meet for this session, this evening session. So we are going to talk about the aspect of discontinued operations. This is whereby you find that the parent has acquired a subsidiary, then this subsidiary is disposed entirely during the year. So I would like to do a question which was tested some times back. That is a question of 2010, December. To be more specific, question 1, so that we address the aspect of a discontinued operation. So this is the relevant question. Of Head Limited sold off its entire shareholding of 80% in Shoulder Limited and acquired 75% of the shares of STEM Limited during the year ended 30th September 2010. Head Limited also acquired 40% of the shares of Anchor Limited. So the following income statement relates to the 4 companies. So you have an income statement there. Then additional information. Head had acquired its shareholding in Shoulder Limited at a cost of 2,200 on 1st October 2007, when the retained earnings of Shoulder were shillings 500. The ordinary share capital of Shoulder Limited was 2,000, and there were no other reserves. The fair value of the non-controlling interest in Shoulder Limited on the same date was 550 million. That is 550 million. Number 2, during the year ended 30th September 2010, Head Limited acquired the investment in STEM and Anchor Limited. The details of the acquisition are as follows. So company date of acquisition, cost of purchase, ordinary share capital, fair value of non-controlling interest. So you are provided with that. Then they said in this sentence, under additional information number 2 here, on the date of its acquisition, STEM Limited had an item of plant that was 270 below its fair value. Plant is depreciated at 20% per annum with a full year's charge in the year of purchase or revaluation. So remember that I said revaluation is the difference between the fair value of that relevant asset and its carrying amount. So obviously, you find that the fair value is higher, or the fair value is in excess of the carrying amount. So when they are testing this aspect of revaluation, they can provide fair value of that asset and they provide the carrying amount. So the fair value will be higher than the carrying amount. So if they have provided, for example, the fair value of 500, they will say the carrying amount is, let's say, 400. So you take the difference and you find that revaluation is 100. Or they can give you the 100 direct by saying that the fair value was in excess of the carrying amount by the 100 concerning those relevant assets of that subsidiary or other investing company. Or they can say that the carrying amount was below the fair value by the 100. So all that statements I've mentioned, the examiner will be testing you the aspect of revaluation gain. So either he gives you revaluation, he provides revaluation direct by saying the fair value was in excess of the carrying amount, or the carrying amount was below the fair value. Or he provides the fair value and he provides the carrying amount. You take the difference. So in this additional information, number 2, you can see that they are giving you the revaluation gain direct by saying on the date of its acquisition, STEM had an item of plant that was 270 below its fair value. Below its fair value, 270 below its fair value. So that is a revaluation gain. So the plant is depreciated at 20% per annum with a full year's charge in the year of purchase or revaluation. So after you have revaluation, after you have the revaluation, after you have this aspect of revaluation, you do what? You compute for depreciation under charge. You compute for depreciation under charge. Alvins, you have been in this group for some time. You have the past papers. Check the past papers which are in the group. So, or someone can again share that document which have these questions. So someone can share, because I'm seeing Alvins is saying that we share again. Number 3, on 1st July 2010, Head sold its investment in Shoulder at a price of 34.30. That is 3,430. This disposal has not been reflected in the income statement of Head Limited. Number 4, during the year, the companies traded as follows. We have selling, company buying. Selling price, gross profit margin, percentage, and sold at the year end. Number 5, goodwill of Shoulder Limited had been impaired by half as at 1st October 2009, that is. Any goodwill arising in STEM Limited and Angle Limited is impaired by 20%. Number 6, all dividends were paid on that 1st August 2010. Required income statement and statement of changes in equity. Income statement and statement of changes in equity. So the first thing you have to analyze is all about the structure. Remember that here Ed sold off its entire shareholding of 80. But you cannot sell something you don't own. You can't sell something you don't own. You can't sell something you don't own. So meaning that even if they disposed the 80% of Shoulder, even if they started by saying that they sold, this Shoulder was acquired some times back. And that one is well illustrated in the additional information, because if I go to the additional information number 1, I can see Shoulder was acquired October 2007. It was acquired October 2007. When was it disposed according to Note 3? 1st July 2010. So meaning that Shoulder was there even before the disposal took place, because the disposal took place on July 2010. That is according to Note 3. Note 1, Shoulder was acquired in 2007. So meaning that even if this question, they started by saying that they sold off Shoulder, Shoulder was initially acquired. Even Anchor and STEM, they were acquired even before they disposed of the Shoulder, because you can see additional information number 2, date of acquisition. When was STEM acquired? January 2010. When was Anchor acquired? April 2010, which is before July. Which is before July when they disposed the Shoulder. So all the 3 companies, that is Shoulder, STEM, and Angle, they were present before Shoulder was disposed. And that is what we need to do first, by showing that relevant structure. So the structure and shareholding. So we say before disposal. So before disposal, these companies were present. So Head had acquired the 3 companies, Shoulder, STEM, and Angle. So the percentages of acquisition, according to my equation here, these companies were acquired up to which percentage? 80%, 75%. At the start of the equation, there's that paragraph talking about the percentages. And the last one is 40%. So these companies were there. Then after disposal, now they disposed Shoulder. So Head remained with who and who? STEM, and they remained with Anchor. So we have 75% and we have 40%. So now we need to check the timing. We need to check the timing. So our financial year ends on 30th September 2010. It starts on 1st October 2009. That is the current year under consideration. So the main thing I need to focus is on shoulder, the time it was disposed, and the stem and angle when they were acquired, because they were never disposed. When was shoulder disposed? According to note 3, shoulder was disposed on July 1st, July. So July 2010. 1st July 2010. So from July to the end of the year, how many months are those? So not to the end of the year, because this one was disposed, we don't check towards the end. We check up to this time because it was disposed the entire this time. So it was existing from the start of the year up to this time. Then from July to the end of the year, it was not there. So that is why we consider it for the first month, this month, up to July. How many months are those? That is 3 plus 6, 9.
9.
So those are 9 months. So you say shoulder is a 9 months discontinued subsidiary. Then what about the other 2? Stem and angle, they were never disposed, they were acquired. So stem was acquired when? According to note 2, it was acquired on January 2010. And the angle was acquired on 1st April. Whoever is unmuted, mute your mic. When you are unmuted, make sure your background is friendly or what you are doing is not making noise on the other side. So from January to the end of the year, January is when stem was acquired. To the end of the year, those are 9 months. Stem is a 9 months continuing because it was there until the end of the year. It was acquired on January, so it existed until the end of the year. Continuing subsidiary. What about ankle? Or this is angel. This is ankle. Ankle. Anyway, we're not concerned about the English. We're concerned about understanding how you do these computations. So this one from April to the end of the year, how many months are those? 6.
6.
6 months continuing associate. So after doing that, now we can do our consolidation. So this is the first thing you do. So if any question, like now the sitting question was very easy. If you are capable of understanding how to interpret this shareholding, you will be able to do the question comfortably. Because the adjustments are the things I've been repeating all of the questions. So it's all about understanding how you interpret. Because once you know that, like now, this is a subsidiary for 9 months, but discontinued. So we have to prepare a separate income statement for that. Then this one are about continuing. So we have to do a separate income statement for the 2. So that is why now I have to go to this side and talk about head remitted, consolidated income statement. So that is for the year. For the year the 13th September 2010. So first, we do 2 income statements, but concurrently. So I will start with continuing operations. So meaning that head will consolidate 2 companies. We'll consolidate stem and ankle. But most of the items I would be considering is that one for STEM, because STEM is the subsidiary. The other one is an associate. You know what we consider for associate are just few items. So we go now to the question. We go to the question. So revenue. $5,000 plus what? $5,000 plus. So STEM will not STEM 4,000. But now STEM was there for 9 months. 9 over 12 times 4,000. Remember, we add the parent plus subsidiaries. Under revenue, we minus intergroup sales. So the intergroup sales of who and who? Remember, we are dealing with, for now, we are dealing with the 3 companies, head, STEM, angle. So the items we eliminate on consolidation are those which occurred between the parent and subsidiaries. We don't eliminate transactions with the associates. So under which additional information did the parent sell to the subsidiary, or the subsidiary sold to the parent? Number 4, head to STEM. The selling price is 300. That is the only thing you minus there. So shilling says in millions. The next item is cost of sales. So cost of sales, we say 2,000 plus 9 over 12 times what? 1,500, minus 300 plus what? UPS. Tell me what's the UPS. This is something you know. 1 minute. So that is UPS on closing stock, which is unsold goods times profit margin. So you get 75, you add. Then there was depreciation. There was depreciation. There was depreciation under charge, which arise due to what? Due to Maureen. Due to what?
Revaluation.
Due to revaluation. Due to revaluation gain. The revaluation gain was provided. They said 270. An item of plant was 270. That is note 2. The sentence which is under note 2. On the date of acquisition, STEM Limited other plant, that was 272. Below what? Below its fair value. So this one was in excess of what? Carrying amount by 270, but below the fair value by 270. So it's not about increase. So once you have your revaluation gain, you take that, you multiply what? The depreciation rate, which is 20%. You get 54. You get your 54. Depreciation under charge, which is supposed to be done what? Added here. Depreciation overcharge is the one you subtract. And the depreciation overcharge arises only when there's an intergroup sale of fixed assets. An intergroup sale of a fixed asset, whereby you need to check first for the unrealized profit on fixed assets. Then you go ahead to compute for the depreciation overcharge. Up to that point, I think you could get gross profit. After gross profit, there's investment income. So the investment income is 300. You need to minus dividends or interest paid by these companies. Now you need to consider both STEM and Uncle. if they paid dividends or interest, we deduct from 300 because you would find that the parent has recognized that as income, and the parent is not supposed to recognize that as an income during the year. The parent is entitled to profit at the end of the period. So the dividends which Stem and Angle paid is 320 and 150. From the income statement, after the profit after tax, those dividends of 320 and 150. So here you say 75% of 320 minus 40% of, that is 150. You consider them to accrue throughout the year. You don't have to consider the aspect of time. Then we go to distribution, costs. So the distribution costs is about 800 plus. For STEM is 850. So say 9/12 times 850. The next is admin. That is administrative expenses, which is 700 plus that of STEM, but STEM we apportioned for 9 months. That is 450. Then I will introduce impairment. So the impairment loss. So this one I have to do working on goodwill for me to get that. For now, I cannot be able to get that. So that I have the profit before what? Before interest and tax. Interest, we consider the finance cost. Interest, we consider the finance cost, which is 600 plus 9/12 times 400. And now, before I deduct tax, I need to consider what the parent was receiving from uncle for the 6 months. So the income from uncle, we say share of profit after tax. Share of profit after tax in uncle. So this one, after this company uncle has paid the tax, the profit which is remaining, the parent is supposed to take 40%, but for the 6 months. So you say 40% of the profit after tax. So the profit after tax in that company was 400, but for the 6 months. So that is an income to the parent. So that we say profit before tax, because I have not deducted the tax of the parent and STEM. So income tax to be deducted here of the parent and STEM, which is 400. That is plus 9/12 times what? 280. So up to this point, we get the profit from continuing operations. This is my A. This is my A. Then we continue with the discontinued operations. It's a continuation. So it's another income statement, but they are prepared concurrently. Now here I will be considering shoulder, only shoulder. So the revenue for shoulder, $3,000, but it was existing for many months, from October to July. From October 2009 to 1st July 2010, that is, only for 9 months, then it was discontinued. So it was in existence for only 9 months. So you say 9/12 times the 3,000. We go to the cost of sales. So cost of sales is 9/12 times 1,200. I think I can continue this side. So revenue, you deduct cost of sales, you get your gross profit. Then after that, you talk about distribution cost. So 9/12 times 200. You talk about admin expense, which is 9/12 times 700. You introduce your impairment, loss. So this one needs a working. So you say profit before interest and tax. So that you introduce finance cost. Finance cost is 300 or what? 9/12 times 300. Then now, before I minus tax, I would have to say gain, stroke loss on disposal. You remember that first requirement of ours in our previous question, in our yesterday's question, the gain or loss on disposal, how you are supposed to determine. Then you say profit before tax, and less income tax. 9/12 times what? 150. So that we have the profit after tax. Not even profit after tax, we say profit from discontinued operations. This is B. Remember, this one was A, profit from continuing. So here we have B. So that we say consolidated profit. We talk about consolidated profit. That is A plus B. After consolidated profit, I will say profit attributable to parent. I can start with profit attributable to NCI, then profit attributable to who? To parent. For the NCI, you need a working. So now we can use our calculator to get those figures, then we do workings, and the question will be done. But workings are the one which will waste our time. So if I was a student, I cannot waste my time in workings during the exam. I will do the structural way, the way I've done. Within the first 40 minutes, this question, I will be done with it, and I have more than 15 marks. I go and do others. That is how I was doing even when I was a student. I know there are some students who have combined 5 and 6. Not 5 and 6. Currently, it's not 5 and 6. So, currently, it's not about advanced level. I know you are doing 4 units. This is very easy to pass. Remember previous, we were combining 6. And you find that we pass all of them. Now, why can't you pass this 4? Because now you have even extra time for the Let's say there's no two, which were there previous. So, and out of the four, one is theory. Or if you have chosen audit in the specialization, two is theory. Mary, unasikia hiyo maneno? Amadha ikiwa moja inakuwa ngumu. Mary, I'm talking to you. So, have you been computing? Eh? So you give me the answers. I think what I'm recording there is correct. Maybe if I make a mistake somewhere, you tell me, because I'm trying to get those figures. But also, if you have them, you mention. This is 0. So this is 10.7.5. We cannot be able to get Goodwill at this point, so that one needs a working. Also, this cannot be, we cannot be able again to get this because we don't have what? We don't have impairment. For us to get impairment, remember we have to do the working. Eh? You know that. Eh? So this is 900. Eh? So this is supposed to be deducted. Then share of profit after tax in Angu. This one is being received by the parent. And that one will be an income. This one is an income to the parent. So it's it's an addition. We cannot be able to get profit before tax because there are some items missing above there. That is impairment. Impairment is missing. We have to do a working. $610. So even this one, we cannot be able to get at this point. So this is 2250. This is 900. So if you take 2250 minus answer, you get 1350. Yeah? This is 150. This is 525. So we need to do a working there. Even this one, we cannot get it. So 300. This is 225. A deduction. This one we need to do a working so that we get this, the profit before tax. So usikue na wewe unaweka question mark kwa kitabu yako. Yes, because we will do workings for those missing items. So just leave a space where I'm putting a question mark. This one is a deduction. Then this one we have to compute. Even these, So up to this point, it's only workings which are remaining. And if you were to do this way and they give you 1 mark for one entry, you were supposed to get how many marks? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. This income statement, it's 18 marks. So you have 15 out of 18. Then you do that statement of changes in equity. You get even your 2 marks. 15 plus 2, 17 out of 20. What do you need? You have to waste time on workings. So the workings you always do are the one which are more important. The one like now, things like UPS, UPFA, depreciation, overcharge, undercharge, things like that. But zile workings zenye zinahitaji time yako yote, hizo ajia examiner. Like now, retained earnings, never waste your time with retained earnings. Michael, yes, that is what I mean. With the way I've done, you can score 10 and above, not even 10, 15 and above. You know that in a farm, I'm trying to look for my question, still imepotea wapi tena. Oh, okay. Remember that in a farm, ajama wenye umake mtihani wako fair sana. Do you know that? Mama unafikiri wanawaumiza sana. They are very fair. So you know, you have been looking at the marking schemes and you know. Maureen, you know that. You have all the marking schemes. Ama hamuna? Na mmenyamaza sana. Michael.
Yes, mwalimu.
Mbona mnanyamaza hivyo? Nawashtua.
Napiga nyamaza ni kusikiza.
Oh. So I'm trying to say that these guys who marks the exam, they are very fair. I think I have shared this marking scheme multiple times on your screen. August 2020, what? 2022. The first question was group. Let's say, for example, this is the statement of financial position. This statement of financial position, it was having 14 marks. So the examiner needed only he needed only 7 correct entries. He multiplies with 2, you get 14. So they went even ahead to multiply by 2. That they need only 7. They multiply by 2, you get 14. Even this one, this is impairment. We did it some time back. It was having 10 marks. They were marking at any 5 correct. They multiply by 2, you get 10. So most of the things that are sitting when they were marking any question, it's if the question is having 10 marks, they need 5 correct entries. So like now, let's say this, if it was this question which was having 18, for now you could be having everything. That is how fair the marking is done. So when you fail, know that maybe you never prepared well enough, but there's another chance. There's now this chance which you need to put more effort, and obviously you will pass. Let's do some workings. So workings. Let's start from impairment. So meanings that under impairment, we do goodwill. We need to do goodwill so that we determine impairment. And you know, goodwill is purchase consideration. You minus what? Share of net assets acquired. The share of net assets acquired. So what I can decide to do is to determine net assets. I get block figures. Instead of doing a lot of work here, I do a small working first to get one block figure for the net assets of shoulder, stem, and the associate, which was anchor. Before we do the goodwill itself, let me get first the net assets. So shoulder. So I have not started doing goodwill, so I'm doing working. So you can even do also the working. So stem and anchor. So you know that net assets, you always get them from where? From the statement of financial position under the equity part. But now this question doesn't have statement of financial position. But it has an additional information which obviously I will check and determine those net assets. Note 1, right now they said head limited acquired shareholding in shoulder at a cost of 2,200 when retained earnings of shoulder were 500. So retained earnings, remember that the retained earnings, we use the retained earnings as acquisition debt. You know that. This is not something I need to talk about because already you know. Retained earnings, use the one as acquisition. So meaning that for shoulder, you are providing with the 500. This and this I will compute. Stem and anchor, I will compute. Let's continue reading note 1. The ordinary share capital of shoulder was 2,000. I will check for stem and anchor as I continue reading. And they said, and there were no other reserves. The fair value of non-controlling interest in shoulder on the same date was 550. When we have the fair value of the non-controlling interest, like now that one of shoulder, when I will be doing my goodwill for shoulder, I will have to use full method. Additional information number 2, they start column whereby I am provided with ordinary share capital of this one, 3,000 and 1,000. Then in the same additional information number 2, in that sentence, which is just immediate after they have provided all those columns of company, date of acquisition, cost of purchase, ordinary share capital, fair value of non-controlling interest, there's an immediate sentence which says, on the date of acquisition, stem add an item of plant was to 70 below its fair value. So we say that that is revaluation, and that one is related to who? To stem. The note 3 is all about concerning the date when they disposed shoulder, which is 1st July. Note 4 is all about sales, that is goods which were sold. Number 5 is all about impairment. The number 6, they said all dividends were paid. So if the dividends were paid and the relevant company is acquired during the year, we need to determine pre-acquisition dividends, which has to be used as part of net assets. Pre-acquisition dividends. Which company was acquired during the year? Stem and Angle. The pre-acquisition dividends for Stem and Angle. Pre-acquisition period. Like now, Stem was acquired on which date? January. The pre-acquisition period is this period. The first month, the first 3 months. Well, this one was 9. From January to the end of the year was 9. So we need to determine pre-acquisition period. Dividends which Stem paid. Dividends paid a dividends of? Stem paid a dividend of? Stem paid a dividend of 320. So times 9/12. Then for Angle, obviously, it was first 6 months because Angle was acquired on April. So from the start of the year to April, total 6 months. 6/12 times. Angle paid a dividend of 150. So meaning that this is 75. And this one is out of 24 students. There's nobody who can provide that answer. 240.
240.
This one is not 9. You cannot rectify me that. This one is 3. I've even explained and said pre is the months before acquisition. So a quarter, 320 over 320 divided by 4. 80.
80.
It's the same way I've considered this from the start of the year until that time it was acquired. It was acquired on April. So from the start of the year to April, 6 months, the first 6 months. Let's go and determine pre-acquisition. It's the same way I will determine pre-acquisition retained earnings. Pre-acquisition retained earnings. Pre-acquisition is the same as acquisition date. For Stem, again, we consider the first 3 months because this one was 9. So retained earnings, you have balance brought down, you have balance carried down, and a profit for the year. From the income statement, retained profit brought forward, Stem, 16. Are you seeing that? And this one is 18. This last second 2 items in that income statement. Then the third rest is that for profit for the year, which is 200. Profit for the year. So you can be able to get the first 6 months so that as acquisition, which is the same as pre-acquisition retained earnings. I can even decide to write here pre-acquisition retained earnings. It's the same as acquisition date. So you say 16 plus you add the 3 months. So the 200, you reduce it. You prorate it the first 3 months. So a quarter of 200 is 50. So this is 1650. Because it's all about 16 plus, so it's 1650. What about, give me the answer for this. You can't be remaining silent this way. I have to check if you understand what I'm doing. Give me the answer for the other now. This one.
1125.
1125.
1125.
1125, eh? Let me confirm. So here, remember that it's all about now for uncle. It was 6 months, eh? Because it was acquired on April. So you consider when your financial year is ending, when it's starting. Remember our financial year was ending on 30th September. 2010, it's starting on 1st October 2009. The next angle was acquired on April 2010. 6. So brought forward here 1,000. Eh? This one is 1250. Profit for the year 250. So you can say 1,000 plus 6/12 times 250. Or I can even decide to start with 1250. 1250 minus, there are 6 months, 6/12 times 250. So it's all about 11. You have said 11. Maureen, you have said 11.
1125.
25.
So that is good. That is correct. Very good. So let's get the totals. So this is 25. So 1650 plus 3,000 plus 270 plus 80, 5,000. Eh? Is that correct? $11.25 plus 1,000 plus 75. This is 2,200. Eh? Are you done, guys? I want to use the same space, this one, to do now Goodwill. So record for me this one somewhere.
No, not yet.
Yeah. Terry, how are you?
I'm fine.
And you are not answering my questions. Or you are following?
I'm following keenly.
So now, are you done or not yet? So here we were doing the aspect of Goodwill. So Goodwill, for shoulder, we use full method. So where we take the purchase consideration as per note 1, it was 2,200. And for it to be full method, you must be provided with fair value of NCI, which is again in note 1. We put on the other column for NCI. Then we raise the share of net assets. The net assets already, we have a block figure, which we have done under the first working we did. We got 2,500. So 80% of 2,500 and the 20% of 2,500. So 80% of 2,500, you get 2,000. 20% of 2,500, you get 500. Then once you do your summations there, the goodwill of the parent is 200, that of NCI is 50. You sum them, you get total goodwill. Then in the additional information, number 5, they have said that this goodwill had been impaired by half by 1st October 2009, which is the start of the current year under consideration. But you know that this goodwill has been computed since the shoulder was acquired, which is 2007. So by 2009, the 1st October 2009, the goodwill has been impaired by half. That one we call it accumulated impairment. That is from 2007 until the start of the current year under consideration. That is why I have here 125. Then we remain with 125, which is the unimpaired goodwill for the current year. So this was shoulder. So meaning that if I go to the impairment part of shoulder, which is under the second statement, the discontinued part, I will never record anything because there was no impairment for the current year. So we go to the computation of the goodwill for STEM. So that we determine this impairment, I have to consider now the goodwill of STEM.
Did you say, teacher, did you say that we will record nothing for STEM because there was no impairment
shoulder.
for that year?
Shoulder.
Of shoulder, okay.
Yes, remember
Okay,
this goodwill
shoulder.
has been impaired by half, by 209. Is 209 the current year? That is the start of the year. So from 207 to the start of 209, remember that our financial year was starting on October 2009, eh? And it was ending on 30th September 2010. Remember, this goodwill we have computed for shoulder is from 207, the time it was acquired. By the start of the year, it had been impaired by half. That is not for the current year. That is just for the previous period, which is accumulated impairment. So for the current year, they never said that we impair. That is why I have nothing here.
Thank you.
All right. So for STEM, again, we use full method. We say purchase consideration, and we talk about fair value of NCI because it's there in note 2, the last column. We have 1270. So purchase consideration was note 2, the second column, the cost of purchase, 37. Eh? Fair value of NCI is in the last column there, 1270, less net assets, so the share of net assets. So net assets, we have 5,000. Eh? We did our working on that. Eh? So this one was acquired 75%, 25% of the 5,000. $5,000 times 0.75, 3750. 0.25 times 5,000, 1250. So this is negative 50, eh? And this is 20. So if you sum them, goodwill will be what? But now these are profit from one source, which cannot be deducted. So here is something I need to do. Just a minute. So the goodwill here is supposed to be 20. So this is a negative from one source, which we can't add with a goodwill, which is a positive from one source, from another source, that is, because this is the parent, this is the NCI. Negative goodwill, you add back under the retained earnings. When I will be doing the statement of changes in equity, I will add this one back. Negative goodwill is to be considered under that retained earnings. So let's impair this. The impairment was 20%, not 5. So this one will be 4. So net goodwill 16. So already we have determined the impairment for STEM. So these four, which I've recorded here. So the one from the workings, which we have done. So now I'm going ahead to do that one, the goodwill of uncle. So I say purchase consideration. So the purchase consideration is when they were purchasing this uncle, they paid how much? $1,000. The cost of purchase, not 2. Less share of net assets. Acquired. So the block figure for net assets. So 40% of from the working, it was 2,200. So this is 880. So you get to 20. That is goodwill. You impair by 20%. So impairment of 20%. 20% of 220 is, you are told in the additional information, I think it's number 5.
44.
You get?
44.
Is that 220 or 120? This one is to 120. So 20% of 120, it's 24. 120 minus 20 minus answer, 96. So that is goodwill. So yeah, 24. So meaning that this one will be 28. The one for stem and angle. So that now I can be able to fill the missing areas, most of them. So 4746 minus 1437.5 minus 1037.5 minus 28. So this one is 2243 minus 900 plus 80. So this is 1423 minus 610 is 813. So what's remaining? What's remaining? This one. Even this one I can be able to determine. It was 1350. Because remember that once we took 2250 minus 900, we got this. Minus this, minus this. 1350 minus 150 minus 525. This is 675. This one, minus, so I cannot minus this because I don't have this. So gain or loss on disposal. Let's compute that. Gain stroke loss on disposal. So gain stock loss on disposal, we say sales proceed. So we raise what? Share of net asset disposed. Share of net asset disposed. We raise an impaired goodwill. Disposed. And we talk about dividend earned and disposed. The dividend earned and disposed. So sales proceeds, once they disposed shoulder, they received what? According to note 3. Remember, shoulder was disposed on July 2010 at a price of 34.90. Share of net asset disposed. That is another small working we do to get share of net assets disposed. So the share of net assets disposed, remember that we talk about ordinary share capital. Retained earnings, we use the one as disposal debt. So ordinary share capital of shoulder, note 1. It was 2,000. Retained earnings as disposal debt. When was it disposed? After 9 months. After the first 9 months. So it was existing for the 9 months, then it was disposed at a certain point, July 2010. Our financial year starts on October 2009. From October 2009 to July, to 1st July 2010, 9 months, the first 9 months. From the start of the year to 1st July 2010. So we have the balance brought down for shoulder, which is 16. At the end is 18. Profit for the year is 200. So to get as a disposal date, we say 16 plus 9/12 times 200, or 18 minus, remember this is 3. 3/12 times 200. So this 1750. Those are the two net assets which were there. We don't have any other net asset for shoulder. So what you do, you add them. You get 3750. So the parent was controlling 80% of 3750. For how many months? For 9. So 0.8 times 3750 times 9/12. So this is 2250. Are we together up to that point? Are we together on what I'm doing?
Yes.
But now net
Yes.
assets. For the net asset, we are not supposed to apportion in any manner. This one, we consider it that it was, the net assets were there as at the end of the year. You don't have to apportion. This statement, the net assets were given is as at the end of the period. So it's just supposed to be 3,000. Record that 3,000. You don't have to apportion this. Then unimpaired goodwill. Goodwill was the goodwill which was unimpaired.
125.
120.
5.
125. So they disposed of. So out of the 125, they disposed of. So you say the parent was controlling 80%. So he disposed everything. So 80% of 125 is
100.
and that is 100. That is what you record there. Did Shoulder pay any dividend so that the parent earned? So dividend earned and disposed. So any dividends which were paid by Shoulder from the question. Any dividends. So the dividends are the one which I have now to apportion because they have not been apportioned in any point. So dividend which Shoulder paid so that the parent earned. Can I clear this?
$250.
So Shoulder paid a dividend of 250. So parent earned. So the parent earned 80%.
80%.
Of that 250 for 9 months. So what do you have? 0.8 times 250 times 9 over 12. 150. And that is what they disposed. They disposed everything because it was 100% of the 150. So just 150. That is what they disposed. So this is 150. So if you do your summation, you get here 180. So meaning that this is 108 positive, meaning that is again 675 minus 225 plus 180. This is 630 minus 112.5. So this is 517.5. So A, this is 813. You add with this one. So consolidated profit A plus B. So 813 plus 517.5. We get 30.5. Then profit attributable to NCI. I think you are done with these. Profit attributable to NCI are working. So you talk about shoulder and the stem. That is where the NCI is for 9 months. For 9 months. 6 9 months. There are 9 months. So you talk about profit after tax in subsidiaries. So the profit after tax in shoulder, you apportion for the first 6 months, for the first 9 months. The profit after tax in shoulder was 450.
450.
450 times 9 over 12. 337.5. For stem, the profit after tax is 520. So 520 times 9 over 12, that is 390. So we adjust this profit by raising UPS if upstream sell. If upstream sell. We raise what next? depreciation undercharge. We add overcharge, that is depreciation overcharge. We less impairment. Impairment will only be deducted here if we use the full method in Goodwill. So UPS was the sale upstream. The sale which occurred, its head, not for its head who was selling to STEM. So there's no upstream sale. There was depreciation undercharge because there was a revaluation according to note 2. Depreciation undercharge was this 54. And this was due to revaluation in the asset of STEM. That is according to note 2. The immediate sentence which is there. So meaning that there is 54 here. But there was no depreciation overcharge because there was no sale of fixed asset. For shoulder, there was no impairment for the current year. But for STEM, there was impairment. The impairment for STEM was this 4. You remember we did the goodwill, then we impaired. And the goodwill of STEM, we used the full method. So we have 4. So we deduct this. So up to this point, I can be able to get adjusted profit. So this is just 337.5. 390 minus 54 minus 4. 332. So NCI profit will be 20% of 337.5 plus 25%.
It's 302, not 332. Sorry.
This is 302. 302. 390 minus 54 minus 4. 332.
332. 330.
It's 332. Maureen, confirm again. So 337.5 plus 0.25 times 332. So this is 150.5, the total of the two. That is what you put here. So that profit attributable to NCI profit attributable to parent, sorry. You take 1330, this one, you deduct 150.5. So you get 1180. Yeah. So the last thing I have to do, according to this question, is STEM not for 6 months? No, STEM was there for 9 months. Mary? STEM was the one which was there for 6 months is the associate, and we don't have to consider associate here. So the last requirement is the statement of changes in equity. Just 3 minutes, we are done. No, we have taken long. So the last requirement, because they needed what? A group statement of group income statement and a statement of changes in equity. 2 marks. So let's do that. I think I can clear this. So here we see head remittent, statement of changes in equity. So for the year, our financial was ending when 30th September 2010. So for the statement of changes in equity, I will consider most the retained earnings. So it's all about the retained earnings, the profits, which would be considered. So I will say retained profit balance brought down. So I will say head, stem, anchor. Then I add the profit, the one which is attributable to parent. This one, 1180. Then I have to deduct what? The dividends paid by parent. Dividends paid by parent. Then I add back negative goodwill. So our negative goodwill. So the negative goodwill was 50. You remember that? What about dividends paid by the parent? From the income statement, the column of head, 500. Dividends paid by that parent. You can see that column of head, there's somewhere they say dividends paid after profit after tax. For the retained profit brought forward for head, retained profit brought forward, 2,500. What about for stem and ankle? 0, 0. Why am I recording 0 and 0? These two entities were acquired in the current year. Stem and ankle were acquired during the current year under consideration. We cannot be able to say that there is a retained profit brought forward for the current year because they never existed in the previous years, so that we brought forward balances from the previous years. So meaning that up to this point we are done. So retained profit, balance, carry down. So we can do the sum of this. 2,500 plus 1180 minus 500 plus 50. What are you getting, guys? What are you getting?
3230.
3230. But why did we not record shoulder? Why did you not mention about shoulder? So we ignored shoulder. So let me say shoulder here. Then here we have head. So head remains to be that's 25. So include shoulder. Shoulder was the second one, and it was acquired some times back. It was 7. So we must consider 80% of the balance brought down for shoulder is the balance brought down for shoulder 16. But this one is from this is from the start of the year, inclusive of that retained earnings which was there in 2007. So when it was acquired in 2007, the retained earnings in that 2007, according to note 1, the retained earnings was, according to note 1,
500.
500. So you deduct here 500. So you get 1100. 1100, 80% of 1100. This is 880, yeah? And this is 0, this is 0. So we take 2500 plus 880 plus 1180 minus 500 plus 50. So this is 4110. So we are done with this question. That is how you were supposed to do it. The income statement and the statement of changes in equity when disposal occurs during the year.